patron, as it happens, was tonight's first speaker, the Honourable Murray Gleeson AC. It's a national body, it's independent. It comprises some 400 elected individuals of exceptional distinction in the discipline of law, who are committed to the advancement of that discipline and to justice according to law in Australia. And fellows are elected by the Academy from the legal profession, practicing legal profession, from legal academia and from the judiciary. And one of the aims of the Academy is to provide a bridge between each of those sections of the legal community, and one can see that in action this evening. Turning then to Kevin Lindgren, the chair, he really needs no introduction by me. He has been a solicitor, partner in a firm of solicitors, an academic, professor, a barrister, Queen's Counsel, judge of the Federal Court of Australia. He's the author of scholarly works. He's a legal educator and an independent mediator, arbitrator and referee. He was admitted as a solicitor of the Supreme Court of New South Wales in 1962. In the same year, he became a partner in the firm of solicitors Harris, Wheeler, Williams and Mackenzie. He completed his PhD at Newcastle University in 1972. He became a professor of law in 1973. He became a member of the New South Wales Bar and relocated to Sydney in 1984. He took silk in 1991. He was the judge of the Federal Court of Australia from 1994 to 2010. He's a life fellow of the Australian Academy of Law, having been its president, my immediate predecessor, between 2011 and 2020. And I can't think of anyone more qualified to chair this evening's session. So, Kevin, if I could call on you next, please.
Yes, thank you, Alan, for that very nice introduction. The title of tonight's event is, for those who already know what Part 4A is about. The event could have been entitled Tax Avoidance in Australia. In the case of Tony Pagone's excellent little book of that title, anyone can open it and decide whether it is for him or her. But for this event, the uninformed might have read into the title Tax Avoidance in Australia the subtitle How to Do It in 3 Easy Lessons, in the manner of the late Peter Klein. We will all learn much tonight from our 4 panelists and 2 commentators. They are all highly qualified and are well known to those who have an interest in the area. Nonetheless, I will introduce all of them in a moment, and then we will hear from the 4 speakers, 13 minutes each, and 2 commentators, 5 minutes each, without further ado. After their presentations, there will be time for questions. You can send in questions via the chat room facility on the screen. I will be noting them as they come in, and time permitting, we'll pass them on in due course. In addition to our knowledgeable speakers and commentators, the list of registrants shows that we also have an impressive audience. So we look forward to receiving some good questions. Murray Gleeson was Chief Justice of the High Court of Australia from 1998 to 2008. Prior to that, he was Chief Justice of New South Wales from 1988 to 1998. As Senior Counsel at the New South Wales Bar, he had a large tax practice, and of special relevance tonight, together with the late Graham Hill, had an important advisory role in connection with the drafting of Part 4A. Tony Pagone has had a long and close association with the law addressing tax avoidance. At the bar, he appeared in several of the leading cases, including Peabody, Spotless, CPH Property, and Hart. As a judge of the Federal Court of Australia, he was the National Coordinating Judge of the Taxation National Practice Area and decided several Part 4A cases, including Channel, Pastoral, and Orica. He is the author, as I mentioned, of Tax Avoidance in Australia, published by the Federation Press in 2010. He's the president of the International Association of Judges and is a former member of the board of the International Association of Tax Judges. Kristen Deards has an extensive taxation practice and appears for taxpayers and the Commissioner in income tax and GST cases in the Administrative Appeals Tribunal, the Federal Court and the High Court of Australia. She has appeared in a large range of tax cases, from complex Part 4A and transfer pricing cases to disputes concerning CGT, the consolidation regime, international tax, superannuation, insurance, trusts and charities. Miranda Stewart is a professor at Melbourne Law School in the University of Melbourne and honorary professor at the Crawford School of Public Policy at the Australian National University. Miranda was the inaugural director of the Tax and Transfer Policy Institute, which is supported by the Crawford School, and she held that position from 2014 to 2017. Professor Stewart researches, teaches and consults on a wide range of taxation law and policy topics. Prior to academia, she worked in the Australian Taxation Office and in private practice. Roger Giles had an extensive tax practice at the New South Wales Bar. He was a judge of the Federal Court of Australia from 1999 to 2008, in which capacity he decided cases on Part 4A, including Hart versus the Commissioner. Between 1982 and 1984, he was the Special Commonwealth Prosecutor into Bottom of the Harbour tax avoidance. He is a former member of the General Anti-Avoidance Rule Panel, the GAR panel. Peter Wormsley is a Deputy Chief Tax Counsel in the Australian Taxation Office, which he joined in 1977. He has been a member or chair of the ATO's GAR panel on and off for 2 decades. During that time, he has had the carriage of a number of the ATO's Part 4A cases, including Commissioner of Taxation versus Hart. So, ladies and gentlemen, that completes the introductions. Now, the technical problem we were having, unfortunately, did concern our first speaker, Murray Gleeson, and I still can't see Murray on the screen.
Can you hear me now?
I can hear you quite well.
Oh.
So I'm afraid, Murray, that will have to be it. We'll listen, and I'll hand over to Murray Gleeson now.
Thank you. Well, I was effaced during the course of the preliminary meeting here, but that's probably a mercy for you all. When about 40 years ago, the Commonwealth Government undertook a reconsideration of the elusive concept of tax avoidance, that reconsideration began with an equation, which is that taxable income equals assessable income minus allowable deductions. That equation is reflected in the basic structure of Part 4A, which aims at the cancellation of tax benefits. To describe the non-derivation of income or the incurring of an expense as a benefit may seem counterintuitive, but the integers of the equation had been referred to in judgments as benefits or advantages. Cancelling tax benefits involved including as assessable income an amount that would otherwise not be regarded as derived by the taxpayer, or disallowing what would otherwise be an allowable deduction. The justification for cancelling the tax benefit is that it's the consequence of a scheme to reduce income tax. The immediate effect of Part 4A was to replace Section 260, which had failed as a general anti-avoidance measure. The framers of Part 4A were aware that there was a respectable body of opinion, both in Australia and internationally, that one of the reasons for the failure of Section 260 was that it was an attempt to give expression to an idea that is inherently nonsensical. The idea that a rational boundary can be drawn between acceptable tax planning and lawful but unacceptable tax avoidance. The pressure to make another attempt to achieve what some people thought to be impossible resulted from a combination of legal and political circumstances that I'll seek to explain. Lawyers distinguish tax avoidance from tax evasion, the latter being a term applied to attempts to escape tax liability by conduct that's illegal, such as deliberately failing to declare income or falsely claiming expenses, by arrangements that are shams, or by schemes that depend for their effectiveness upon the evidence of them being hidden, as, for example, by being sent to the bottom of Sydney Harbour. That distinction is important, but the prevalence of tax evasion as well as tax avoidance was part of the background to a political necessity to act in an environment where there had been a collapse of morale. My primary concern is with lawful conduct, which may or may not be categorised as tax avoidance. It may be that Roger Giles will say something about the darker side. One matter of significance in understanding the context in 1981 and some of the analysis that appears in judgments about tax avoidance is that there was then no specific capital gains tax. The distinction between income and capital, well known in the law of trusts, was taken up in the Income Tax Assessment Act. Obtaining a financial benefit in the form of a capital gain rather than a receipt of income was an obvious example of a financial advantage that was in general terms outside the purview of a regime that taxed the derivation of income but not capital gains. It also provided a commonplace example of the difficulty of formulating what is meant by tax avoidance. In 1958, in Newton, the Privy Council sought to explain the concept by contrasting an arrangement concerning which you were able to predicate by looking at the overt acts by which it was implemented, that it was implemented in that way so as to avoid tax, contrasting that with a transaction that was capable of explanation by reference to ordinary business or family dealings without necessarily being labelled as a means to avoid tax. An example that was given and said to fall into the second category was a transfer of shares cum dividend. The Privy Council said that no one looking at such a transfer could predicate that it was made to avoid tax. And I think it's worth reflecting on that example. Suppose an investor received a letter from a stockbroker saying, if you're thinking of selling your shares in X Limited, you should do it this week because next week they'll go ex-dividend, and that will expose you to a liability to income tax, whereas if you sell them now, you'll receive the benefit of their current value, including undistributed profits, on capital account. The first thing the Privy Council would say about that is that the letter is irrelevant. The taxpayer's subjective motivation doesn't matter. And I think that has to be correct. A rational tax system can't vary in its operation according to the fiscal awareness of individual taxpayers. Then the Privy Council said, looking at the overt acts, it couldn't be predicated that its purpose was to avoid tax. It was capable of explanation as an ordinary business dealing, a sale of shares by an investor. That's also correct, but surely there's a more basic explanation. There was nothing done that avoided tax. The relevant tax was a tax on income, not capital. The only possible relevant income was dividend income. The investor didn't derive dividend income. There was simply the sale of an asset. And that was a transaction about which the then income tax law simply had nothing to say. But what if there was more to it than that? Suppose instead of selling the shares on the market, the investor sold them to a corporation that he or she controlled. Suppose the corporation had features that neutralised the tax effect of the dividend. And suppose after the dividend was paid, the corporation sold the shares back to the investor at the ex-dividend value, perhaps thereby incurring a loss. That scenario has some of the elements of a scheme of tax avoidance that by the middle of the 20th century was so well known it had its own name. Among other things, that example shows the importance of identifying what constitutes the scheme, if there's said to be one, and that again is reflected in the structure of Part 4A. I intend to refer to only three cases, one in 1957 Keary in the High Court, Newton in 1958, and then Cridland in 1977. Abolition of Australian appeals to the Privy Council was brought about by a gradual process that began in 1968 and ended with the Australia Acts of 1986. The Privy Council's attempt in 1958 to rationalise Section 260 found little favour with the High Court, especially after the High Court became the final court of appeal in tax cases. From the point of view of the revenue authorities, the receding tide reached low water mark in 1977 in the case of Cridland. The leading judgment was that of Sir Anthony Mason. His statement of the fact shows why it might have been thought Section 260 could have been relevant, as the primary judge, Dennis Marnie, found that it was. The Income Tax Assessment Act enabled primary producers to average their income over a number of years. This was beneficial to people whose income was unstable. An accountant established a discretionary trust. The trustee acquired land to be used for primary production. Pamphlets were distributed within universities, and more than 5,000 students subscribed to become potential discretionary income beneficiaries for the sum of $1, which many of them didn't bother to pay. They didn't get or expect to get any financial return or any benefit except the right to average their income for tax purposes. The people in search of a tax advantage were not multinational corporations or banks or media barons. They were thousands of university students who became primary producers for the cost of $1. And that case reflected the spirit of the times and cruelly exposed the weakness of Section 260. The High Court found in favour of the taxpayer, applying the choice principle, best known for its application in 1957 in Keary. The court took the view that there's no relevant alteration of incidence of tax and no tax avoidance where a taxpayer deliberately pursues a course of action to which the Act attaches benefits. And that's a view not confined to cases where the Act offers a choice of alternative consequences. One aspect of income tax that has to be allowed for in any consideration of tax avoidance is that there are provisions in the Act which are there for the purpose of encouraging taxpayers to do certain things, such as provisions conferring tax benefits from investing in certain kinds of activity or for donating money to charities. A taxpayer who responds to that encouragement is not defeating, but is fulfilling a legislative purpose, and that matter, of course, had to be dealt with in Part 4A. But underlying the choice principle was another aspect of tax law. A tax is based on the selection by Parliament of a criterion of liability, which may be simple or complex. A simple example is a road toll imposed on people who drive along a designated highway. A motorist who travels along an alternative road, for whatever reason, is not avoiding the toll. Parliament has decided to impose a toll on one road and not the other. Parliament has made a choice as to the criterion of liability. It's Parliament's choice that determines the fiscal consequences of the course of conduct. The decision in Cridland, which preceded Part 4A by 4 years, was a death blow to Section 260. If the section didn't prevent urbanised students from being treated as primary producers by subscribing $1 to a discretionary trust scheme, then it was hard to see what it would prevent. As it happens, 4 years after its repeal, Section 260 was applied by the High Court to a pre-1981 scheme undertaken by some medical practitioners. That caused some political consternation, resulting from the fact that it gave rise to the worrying possibility that some controversial retrospective legislation, which had earlier been passed and which divided the governing parties, might not have been necessary. In that case, the dissenting judge, Justice Dean, referred to the previous line of High Court authority, and he said of Newton's case that where it gave as an example of a scheme that couldn't be predicated as one to avoid tax, the tax planning device that had been adopted in Keary, then it had introduced what he called a Trojan horse. The Privy Council's acceptance and rationalisation of Keary proved the undoing of Newton. The High Court's reasons in Keary were consistent with its later decisions down to the late 1970s. What was done didn't alter the incidence of tax. The two examples given in Newton's case of conduct that fell on the right side of the predication test were both unfortunate. One was an unconvincing attempt to accommodate the High Court's recent decision in Keary, and the other was an example of conduct that appears to involve no avoidance of tax, an investor who sells shares come dividend. But the very fact that the Privy Council seemed to treat that as an example of something that might at least be thought to avoid tax illustrates the problems involved in the concept of tax avoidance. Such was the collapse of Section 260 that in much of the litigation in the 1970s involving tax minimisation, the revenue authorities didn't attempt to rely on it. In the 1970s, it was difficult to pick a fight with the Commissioner of Taxation in relation to Section 260. There was widespread political frustration with what was called artificial and contrived tax minimisation. But there is a symbiotic relationship between the complexity of tax planning and the complexity of tax legislation. Business and family arrangements that might have been regarded as extraordinary in the past may later become ordinary in response to development in tax and other legislation. Two of the main weaknesses of Section 260 were its vagueness as to the kind of conduct that would attract its operation and the blunt instrument of voidness that it employed as a consequence of a finding that there was a scheme. As at 1981, the rationalisation of the concept of tax avoidance offered by the Privy Council in Newton was seen by the Australian government and its advisers as the best available explanation of what a general anti-avoidance provision was seeking to achieve. Such a provision was not intended as a safety net aimed at protecting the revenue from what turns out to be an unfortunate choice of a criterion of tax liability, nor was it an attempt to undermine the principle that within the limits of what's lawful, it's for taxpayers themselves to decide how they carry on their business. The original structure of Part 4A included the idea of cancelling tax benefits identified by reference to the integers of liability that I mentioned earlier. The history of Part 4A since then has been one of increasing elaboration. That's not surprising. I read somewhere without understanding it that the second law of thermodynamics says that all change is in the direction of complexity, and that has been my observation in relation to the legal system. There remain two fundamental questions that still have to be answered. The first of all is the question, is it possible to draw a rational boundary between legitimate tax planning and lawful but unacceptable tax avoidance? And the second question is there a better way of doing it than this? And presumably those questions may be pursued in later contributions to this discussion. Thank you.
Thank you very much, Murray. And now I'll call on Tony Pagoni to speak. Thank you.
Thank you, Kevin, and thank you, Murray, for that introductory background to Part 4A. The story of Part 4A up until 1991 was told by the late Neil Forsyth QC in a homely story about a big black dog. Forsyth related that John, the owner of a big bank, decided to buy a very large, black, savage-looking dog given the code name 177D. The decision to buy the dog was made in a flash of inspiration because the bank had suffered a number of disturbing armed robberies. At first, however, John and the then assistant manager, called Trevor, put at ease the fear of customers and neighbours by explaining to everyone that the dog was well trained. They told the dog to sit, and it sat. They told the dog to shake hands, and it shook hands. They asked little girls to go up to pet the dog, and when they did, it wagged its tail. By 1991, the bank manager had become Paul and the assistant manager, Trevor, had become the manager. Occasionally the dog would growl, but with increasing frequency, it began to attack neighbours and customers, and it became less and less clear exactly why he should attack one person rather than another. It was not until 1994 that the activities of the big black dog first came to the attention of the dog catcher. Its presence had been noted before in cases like Gulland, but the first serious complaint about the big black dog was in 1994, when it was complained that 177D could not attack a scheme of a customer, being a taxpayer, who had not obtained a tax benefit or in respect of which the taxpayer could not reasonably be expected to obtain a tax benefit. In Peabody, 177D, our big black dog, had attacked a scheme to include in the assessable income of Mrs. Peabody an amount referable to the sale of shares through a public float. It was successfully argued for Mrs. Peabody that she had not obtained a tax benefit in connection with a devaluation of shares because the amount which had been included in her assessable income could not reasonably be said would have been included or might reasonably have been expected to have been included in the year of income had a devaluation of shares not taking place. It was an important muzzle upon 177D, to which the court, the dog catcher, added an observation that a scheme to which 177 might apply required a set of circumstances capable of standing on their own without being robbed of all practical meaning. There were not too many people who were sure exactly what practical meaning should have been given to that observation until it was clarified in 2004. But most importantly, in Peabody, it was decided that our big black dog could attack a scheme where objectively there was a tax benefit and the tax benefit was objectively obtained in connection with a scheme. Both were said to be posited as objective facts and were not made to depend upon an opinion or a state of satisfaction. It was an important result for the further actions of 177D, in part because our big black dog could not attack a scheme unless there were probative foundations for concluding that there was, or might reasonably be concluded to be, a tax benefit. But also because 177D could attack schemes and defend the attack upon objective circumstances. A taxpayer, for his, her, or its part, needed to succeed by showing the absence of those objective circumstances rather than by showing error in the application of Part 4A by the bank manager or the bank owner. The latter was bolstered by the provisions conferring evidentiary conclusiveness upon the production of a piece of paper called an assessment, and by limiting the statutory review and appeal proceedings to challenges and any challenges to the correctness of the amount and of the particulars of an assessment. The first big direct challenge to 177D came in 1996, when our big black dog attacked an arrangement that had allowed a taxpayer to derive foreign source income that was not subject to tax. Now, it might seem strange that 177D, our big black dog, might attack circumstances that Section 23Q contemplated as non-assessable foreign source income. And indeed, two levels of dog catchers had unanimously been of the view that 177D had incorrectly attacked the arrangement. But the High Court in Spotless, that is the ultimate dog catching court, decided that it was otherwise. The decision in Spotless by the ultimate appellate court was of considerable significance in affirming that 177D could attack circumstances that were so arranged that their explanation was predominantly the tax benefit obtained and not what the transactions might otherwise have suggested. It was not sufficient that the tax benefit might have been commercially attractive if the dominant purpose of the transaction was the tax benefit. Much was said by the court to turn upon the identification of which purpose was dominant in the sense of being the ruling, prevailing, or most influential purpose. It was not enough that the decision was commercially rational if the tax benefit so predominated in supplying the character of the dominant purpose of the arrangement. The flip side of the same coin came to be considered in 2004 when 177D attacked borrowings which had been used by Mr. and Mrs. Hart to finance real estate. In Spotless, the taxpayer had earned interest income that was not assessable to tax because Section 23Q had said that foreign source income was not assessable. In Hart, the taxpayer had incurred interest outgoings that were ordinarily deductible under the general deduction provisions, but they were held not to be deductible. In Hart, it was seen that the dominant purpose of a split loan arrangement offered by an ordinary commercial bank to Mr. and Mrs. Hart was the obtaining of the tax benefit, namely the tax deduction, rather than the money which had undoubtedly been borrowed. The economic effect of the transaction for Mr. and Mrs. Hart had been to enable them to maximise the tax deductions they were able to claim for the total interest they had been paying for loans which, if undertaken separately, would only be deductible to the extent that the interest related to the borrowings for an income-earning investment decision. The decision in Hart also clarified that the observation that had been made in Peabody about things needing to stand on their own without being robbed of all practical meaning did not mean, apparently, what many had thought it meant. However, unfortunately, there was another observation in Hart on a different point that had significant consequences for the activities of our big black dog 177D. It was observed in Hart that 177D contemplated a comparison between the scheme in question and an alternative postulate. In a series of subsequent cases, the focus of challenge to the activities of 177D came to be whether a tax benefit had been established by reference to a sufficiently reliable postulate, and that eventually led to significant amendments in 2013. The issue raised by those cases was whether another dog, this one codenamed 177C, prevented 177D from attacking schemes where the tax benefit would have been obtained had the scheme not been entered into. In Lenzo, it was decided that 17C required a comparison between what was done and what else a taxpayer might have done in the absence of the scheme before 177D could attack. In AXA Asia Pacific, Justice Jessup said that 177C required that one ignored the scheme to be attacked by 177D, not the facts, and that for 177D to attack, 177C assumed that the scheme had not been entered into or carried out. Plainly, there was some need for some amendment. Well, other amendments have been made, or at least other provisions have been enacted to affect 177D. In 2015, amendments were made to extend Part 4A to schemes sought to limit a taxable presence in Australia. To the work of 177D was then added legislative changes to the transfer pricing provisions, and in August 2018, substantial rules were enacted to deal with what were considered to be international hybrid mismatch arrangements. Well, to conclude, as did the late Neil Forsyth, that is some of how things have gone at this stage, and it is wondered what will happen next.
Thank you very much, Tony. I'll now call on Kristen Deards to speak. Thank you, Kristen.
Thank you. This part of our journey through the history of Part 4A arises from the tax benefit cases that emerged between around 2008 and 2012, culminating in the unholy trinity of the Federal Court decisions in RCI, AXA and Futuris. I'm going to traverse those cases to set the scene for my observations on the amendments that those cases inspired. In RCI, the scheme involved a payment of a dividend and a subsequent disposal of shares. The taxpayer managed to convince the full court that the counterfactual was not the sale of shares without the payment of the dividend, as the Commissioner contended, but instead the correct counterfactual was that the taxpayer would have abandoned or postponed an entire restructure. The critical evidence in that respect was that the taxpayer was sensitive to transaction costs of the magnitude of the capital gain that it would have had to wear on the Commissioner's counterfactual, and that meant that the counterfactual wasn't a reasonable prediction of what might have occurred. So in other words, the tax impost was the reason there was no tax benefit. AXA, which has already been mentioned, involved a rollover and a sale to Macquarie Bank, Bupa. The Commissioner put a counterfactual that involved a direct sale. That counterfactual was rejected at first instance and on appeal because it would have given rise to a CGT liability of such a magnitude that the transaction would not be profitable for Macquarie, and that could never happen. Futuris concerned a reorganisation of shares and assets prior to the sale of a subsidiary. The Commissioner's counterfactual involved two steps, which would have exposed the taxpayer to two lots of tax. The court found that it could not reasonably be expected the group would have chosen to do that. The taxpayer relied on expert evidence from an independent corporate finance specialist who identified alternative ways the restructure and sale could have been achieved. It's important to remember that a foundation for these cases had been laid by a series of earlier decisions which had demonstrated that a wider scope might be possible when it comes to imagining the tax benefit. In McCutcheon, the court found that it's possible for the taxpayer to give direct evidence as to what he or she would have done if the scheme had not been entered into or carried out, provided it's supported by what it called foundation facts, so that the evidence is not merely speculation. In Trail Brothers, the court went so far as to say that it's conceivable that a taxpayer might not even need to leave positive evidence of an alternative postulate because, for example, the result of any objective inquiry of the alternative postulate is inevitable. There are a number of perceived weaknesses that the Commissioner and Treasury saw emerging from these cases. The first was that the alternative postulate or counterfactual had become too much of an open-ended inquiry. The second was that the taxpayer could argue successfully that tax costs would have caused the parties to the scheme to do nothing. This meant that the concept of tax benefit and the identification of the counterfactual in particular was operating as a shield, perhaps a dog shield, in a manner that the Commissioner felt was never intended by Part 4A. The series of cases convinced the ATO and Treasury that there was a structural problem. The government addressed this perceived structural problem by enacting a series of amendments announced on the 1st of March 2012, but applicable to schemes that commenced to be entered into or carried out on or after the 16th of November 2012, which is the date on which the exposure draft of the bill was released for public comment. The amendment centred around the introduction of a new Section 177CB and some amendments to 177D and 177F. There were three main aspects to the changes. The first was the bifurcation of what's described in the explanatory memorandum to be the two limbs of the definition of tax benefit: would have and might reasonably be expected to have. The second is the series of statutory instructions, or confinements to be more accurate, that apply to each of those limbs. And the third is a resetting of the relationship between tax benefit and purpose in the broader context of Part 4A. The bifurcation of the two limbs is achieved by splitting up what was originally a single phrase into two subsections of 177CB, subsection 2 and subsection 3. The explanatory memorandum explains that the architecture of this section is intended to confirm that the two limbs are separate and alternative tests. The EM says that the cases dealing with what it calls the second limb, such as Peabody, Spotless, Hart, involved a reconstruction exercise, whereas the cases dealing with the first limb, like Pusey, Slight, for example, involved what the EM described as an annihilation approach. This taxonomy of reconstruction and annihilation is not found in the cases themselves. It emerges from the classification in the EM. A contrast is then drawn in the EM with the approach taken in some of the decisions handed down during the bad years. In both Futurus and Trail Brothers, the court approached the phrase would have occurred or might reasonably have been expected to have occurred as if they were simply different points along a spectrum of certainty. But the amendments put it beyond doubt that there are now two limbs, the annihilation limb and the reconstruction limb. And that brings us to the second part of the amendments, which is a series of quite different statutory instructions that apply to each limb. The would have or annihilation limb is dealt with in subsection 2, and it requires a postulate that comprises only the events and circumstances that actually happened or existed. And this is specifically designed to stop speculation. It simply deletes the scheme. The second limb, or reconstruction limb, is dealt with in subsection 3, which requires that the counterfactual be a reasonable alternative to entering into or carrying out the scheme. It can include a reconstruction of things that happened outside the scheme. It involves an inquiry into other ways that the non-tax results of the scheme might reasonably be achieved without the impugned tax results. A more significant change then comes in the second part of subsection 4. It provides instructions for the determination of the second limb. It says that one must have particular regard to two things. Firstly, the substance of the scheme, and secondly, the result of the taxpayer that would be achieved by the scheme. It's worth pointing out that this is not an exclusive list of relevant matters. Other matters can also be taken into account, although they might have to be given less weight. Subsection 4 also tells us to disregard any result in relation to the operation of the Tax Act for any person, whether or not they're a party to the scheme. This is clearly directed to the cases I mentioned earlier, where the Commissioner's counterfactual was rejected because it came with too large a tax bill. The final amendment was to section 177D and was intended to deal with the relationship between tax benefit and purpose. 177D(1) now raises the question of purpose first, without mentioning tax benefit as an anterior and separate integer. Corresponding change was also made to section 177F to take the emphasis away from tax benefit. It no longer begins where a tax benefit has been obtained in connection with the scheme to which this part applies. It now says where this part applies to a scheme in connection with which a tax benefit has been obtained. The EM indicates that the intention is to ensure that the question of dominant purpose is asked first, before the tax benefit or counterfactual question. And it takes as its inspiration the comments made by Justice Callanan in Hart, that the question of purpose is the fulcrum upon which Part 4A turns. At this point, I'll say a bit more about three things: the annihilation approach and the circumstances in which it might apply, the extent of the reconstruction, and the primacy of purpose. The description of the would have limb as an annihilation approach brings with it echoes of old labels. It's limited to the removal of the scheme. That means that it will be applied principally in cases where the offensive tax effect is a deduction. It may well be that it can operate in an income case, and the EM raises a scenario in example 1.2 where the taxpayer is a foreign resident and enters into an arrangement where income, which would have otherwise been derived as Australian source income, is derived instead as foreign source income. We're told in the text of the example that the only operation of the scheme is to change the source of income for taxation purposes. One difficulty with this example might be that the annihilation of the scheme would take with it the derivation of the income. It's easy to see how foreign source income might be reconstructed as Australian source income, but a bit less clear how the annihilation approach assists to identify the tax benefit. The trick is, I suspect, that the example doesn't reveal how the future Australian source income is converted to foreign source income by the scheme, and perhaps the real trick is in how to define the scheme to avoid throwing the baby out with the bathwater. So how does one know when the annihilation limb applies and when the reconstruction limb applies? The EM explains that the annihilation limb will apply where the mere deletion of the scheme exposes what it calls a coherent taxable situation. More specifically, the annihilation limb is to be applied where the scheme has no material non-tax results. That is, where the scheme can only be explained by reference to tax and has no commercial or other purpose. A further issue that arises is how the reconstruction approach will deal with one of the points that arose in Lenzo and Trail Brothers, where it was contemplated that the counterfactual can give rise to a different sort of deduction for a different expense. It seems to me to remain open, but perhaps within a circumscribed boundary. While Section 177 CB3 does not have in it any restrictions on positing facts that did not occur, in determining the counterfactual, one does have to pay particular regard to the substance of the scheme and the non-tax results of the scheme for the taxpayer. Provided there's some foundation evidence to support a different outlay and thus a different deduction, and that outlay and deduction are consistent with the substance of the scheme and the non-tax results, it seems that an argument could still be possible. What the reconstruction limb does not do is prevent the taxpayer or the commissioner from raising a do-nothing or deferral alternative postulate like the one found in RCI. A do-nothing counterfactual is still perfectly acceptable as a reconstruction. What the amendments achieve is that the basis on which RCI established a do-nothing or deferral counterfactual, namely the tax effect of the Commissioner's alternative, is forbidden. Another more subtle change, or perhaps clarification, seems to address the question as to whether or not there can be more than one reasonable alternative. In RCI, this question, or something like it, was resolved by characterising the identification of the counterfactual as a search for the most reasonable alternative, implying that there's only one. However, subsection 3 says a reasonable alternative. It seems that the intention is to recognise that there can be more than one. Finally, I have to admit I have some difficulty in understanding how the amendments to section 177D and F to reverse the order in which one asks the question concerning tax benefit and purpose will actually operate in practice. Asking the purpose question first involves determining whether a party to the scheme entered into the scheme or carried it out for the purpose of enabling a taxpayer to obtain a tax benefit. I have trouble working out how this would work without identifying a scheme and a tax benefit. One might start with an analysis of purpose and conclude at a general level that a transaction appears tax-driven, but it's still necessary to identify a counterfactual and a tax benefit, and it seems that one would have to circle back and check that the purpose related to that scheme and that tax benefit. So, what does the Federal Court have to say about the amended Part 4A? The answer is nothing. While this legislation has been on the books for 8 years, it has not been the subject of any Federal Court decision. And so why is that? The simple answer may be that these things take quite a while to filter through the system. Running a case about events that took place a decade ago or more is not at all unusual in tax. But it's also worth noting that there's been a distinct lack of Part 4A activity of any description in the Federal Court in the last 10 years. There have been a few notable cases, such as Orica and Mongoose, but they're few and far between. It's hard to say why this is. One thing to remember, though, is that the 2013 amendments that I've been discussing also brought into effect the new transfer pricing regime, and that's been applied and litigated with some gusto. One can only run so many big cases. My own anecdata indicates that there's no lack of Part 4A determinations being made. The lack of litigation may be that there is a better appreciation of risk on both sides, and so disputes are being routinely settled. That might be good for taxpayers, less so for barristers. I look forward to the first case testing the new amendments. Thank you.
Thank you very much, Kristen. And now we'll turn to Professor Miranda Stewart. Thank you.
Thanks very much. Can I confirm that you can hear me okay? Yes. Great, thank you. The Honourable Mr Gleeson observed that the GAR was not intended as a safety net for the Parliament in respect of a choice of criteria for taxation by the Parliament, and also referred to the question of who is doing tax avoidance. in the example of Cridlin being university students who paid $1 and not multinational enterprises. So both of those remarks have particular relevance to the GAR as it currently stands in the international tax context. So my role is to bring us up to date to an extent, outlining the developments and changes to the GAR applying to international transactions and specifically multinational tax avoidance that have occurred since 2015. There are also quite a number of other anti-abuse developments and elements in the new international tax context for large business at least. So we've already heard about spotless services from the Honourable Tony Pagoni as regards tax and commercial purpose. It's interesting just to make the observation that, of course, the GAR has had a role in drawing the boundaries of international tax in Australia already in its earlier form under Part 4A. Through its application, for example, in spotless, where the taxpayers were obtaining the benefit of the exemption of foreign source income that was subject to even a small amount of foreign tax in Section 23Q. It is also worth observing that those rules were repealed and replaced with the foreign tax credit regime almost immediately after the transactions that were subject to the spotless services case. It was nearly a decade later by the time the case got to the High Court, but by then the exemption was long gone and the jurisdiction was established on the basis of worldwide income. Subsequently, of course, controlled foreign corporation rules were introduced to affirm that jurisdiction with our exemptions only for foreign active business income. So the GAR has played that role for some time. Of course, it was dramatically expanded after the BEPS project commenced, the base erosion and profit shifting project of the G20 and the OECD, nearly a decade ago now, commencing soon after the global financial crisis, which pales somewhat compared to the financial crisis of the COVID-19 pandemic. So some will be aware that at that time, Australia was a chair of the G20 in 2014. The BEPS project commenced. The OECD recommended various reforms that were targeted at corporate tax avoidance. There was a lot of concern about multinational, international tax minimisation, if not avoidance as such, but international tax arbitrage, the use of gaps between the laws of different countries, and reliance on treaty benefits. There had been a prior debate internationally about anti-abuse rules applying to treaty benefits. Of course, Australia always preserved the application of Part 4A in respect of international transactions under the International Agreements Act. So it's interesting to observe that Treasurer Hockey at the time if you like, jumped the gun and took inspiration from the United Kingdom, which before the OECD made its BEPS recommendations, enacted what they called a diverted profits tax. The UK rules were in response to fairly heated public debate and anxiety, including about Starbucks, which had apparently been paying very little tax in its global markets, including in the UK. And there was obviously a lot of concern about large digital platform companies, Google being another example, which were paying tax in the US when they operated there, but not paying very much tax around the world on their global profits in their consumer markets in other countries, including Australia. So we had the introduction after the 2015 budget, and then in 2016 in a series of two pieces of legislation to do with multinational integrity and the multinational anti-avoidance rules. The MAL, Multinational Anti-Avoidance Law, now in Section 177DA, was introduced first, and then a year later, the diverted profits tax. And these statutory extensions to the GAR took effect in 2016 and 2017. So these rules added in essentially a whole new sort of specific kind of anti-avoidance rule into Part 4A. Now, of course, Part 4A has had targeted rules in it from the very beginning. It had the rule on dividend stripping in Section 177E, and then we subsequently saw the extension of Part 4A rules to franking credit schemes, franking credit trading and streaming arrangements. Both of those rules have their own purpose test, but refer to some extent to concepts of a scheme to obtain those specific kinds of benefit. So the MAL in 177DA and the diverted profits tax apply to significant global entities. These are large corporations with a threshold of at least $1 billion Australian dollars globally. So that's across the global group. So obviously large business, but not only the very largest. And are intended to apply to schemes where there is a principal purpose, or one of the principal purposes is to obtain an Australian tax benefit, or both an Australian and foreign tax benefit in a particular circumstance or kind of transaction. The MAL essentially addresses the situation where there are some activities in Australia to do with marketing or selling goods from offshore, goods or services from offshore into Australian consumers. But the activity in Australia does not reach the level of a permanent establishment such that we would apply our general corporate tax rules to it, either under a treaty or under our domestic law. So where that happens, we have income derived by a foreign entity in relation to the selling onshore. So, for example, Google operating in Australia and having advertising revenue in Australia. That we have that supply of a good or service. We have an Australian entity that is an associate or commercially dependent on the foreign entity. Some or all of the income derived by the foreign entity is found not to be attributable to an Australian PE, and we have this principal purpose of obtaining a tax benefit, essentially being not taxed on that amount. The MAL has not been, as far as I'm aware, tested in the courts, but it has been the subject of considerable administrative guidance and engagement between the Commissioner and large corporations in Australia. It was originally suggested it would only apply to a few large corporations, but subsequently estimated that there would be about 1,000 entities that would be subject potentially to the regime. The threshold is much smaller than the current inclusive framework negotiation about allocating tax to market jurisdictions, which is a 20 billion euro global threshold and probably only applies to the top 100 corporate groups globally. The second element for Part 4A, of course, was to introduce the diverted profits tax, which added a new tax, an additional tax at a penalty rate of 40%, where it was found to be breached, essentially the taxpayer diverting through a contrived arrangement profit away from an Australian entity offshore. There are various thresholds and requirements that I won't go into, de minimis threshold. There is a sufficient foreign tax test. So if the group did pay what the rule calls 80% of what Australian liability would have been, that they will be outside the rule, and a sufficient economic substance test, which recalls the comments of Kristen Deard about economic substance. So what are we to make of these two additions to the rules in the GAR? Well, of course, we talk about the GAR, but what we're talking about legislatively is Part 4A. And one of the reasons that these rules were put into Part 4A was to ensure that they would override treaties, as we do already because of the International Agreements Act. It has been suggested that these anti-abuse rules are a kind of treaty override, asserting jurisdiction to tax on the basis of a PE or profits attributed to it, even where where a treaty would not otherwise apply that or domestic law would not. Of course, there must be a purpose. What's also interesting, of course, is that the purpose test is different from the sole or dominant purpose test in the normal application of 177D. We don't know very much about what principal purpose means. Presumably it's somewhat lesser than a sole or dominant purpose. There is some recent guidance on that. Conscious of time, just to sort of align that with other developments internationally, Australia has also signed the multilateral instrument enacting or introducing an anti-abuse rule, the principal purpose test, into our treaties, where we do not otherwise have an existing limitation of benefits rule. And so we have that similar language coming out of the OECD. So my final remark on this, obviously, we haven't finished these developments internationally. They're all still moving along, but really we are potentially adapting what should be a marginal anti-avoidance rule in such a way as to really make big steps on jurisdiction. And it's to be hoped that the latest negotiations on international tax will present clearer rules about our jurisdiction to tax, and arguably we shouldn't be having the GAR applying that way. In that regard, one of the measures in the inclusive framework negotiation is that unilateral measures should be withdrawn, and there is a question as to whether the MAL and DPT might qualify as unilateral measures that Australia should withdraw. Thanks very much, Kevin.
Yes, thank you very much, Miranda. I hope we have Roger Giles. I can't see him, but I see his initials. Can you hear Roger?
Am I not in view?
You are now.
Good.
We can see you and hear you now. Yes.
Good, good.
Thank you.
Well, in the fine tradition of commentators, I'll say a few words of my own first before making any comments. Now, and a bit of history. I accepted appointment in 1982 as the Commonwealth Special Prosecutor in relation to bottom of the harbour tax rules that had been brought to light by the Costigan Royal Commission. The widely marketed scheme was directed to extracting the undistributed profit of private companies without paying Division 7 tax. So those profits are $100,000 and there are net assets of that amount. The promoter would acquire the shares in the company for, say, $75,000 through a shelf company with men of straw as directors, appoint men of straw as directors of the target company, sell the assets, pocket the proceeds, and dispose of the books and records to the bottom of the harbour. The commissioner would be left to try and collect tax from two insolvent companies. The political scandal that ensued threatened the Fraser government. John Howard, as Treasurer, introduced retrospective legislation to claw back some of the lost revenue. That was also controversial. The Special Prosecutor was to coordinate criminal and civil remedies. On appointment, I inquired about the cases that I was to prosecute. I was told that no cases had been prepared. One had been referred to the AGS in Perth, but was in the relevant officer's bottom drawer while he facilitated the escort service being run by his wife. I then turned my mind to civil cases. The cases, in my view, reflected tax avoidance appropriate for the application of Section 260. The contention by some that the High Court decision, some including the promoters, that the High Court decision in Slutskin would preclude the use of 260 to ask the ATO officers about the civil cases. I was told that one case had been prepared, applying 260, but that the Commissioner did not propose to pursue it. I should say that the retrospective legislation did not capture all of the tax that would be recouped if Section 260 applied. And the difference was very significant over the myriad of cases then that had been on foot. I learned that Murray Gleeson had been briefed in that case and was of opinion that it would succeed. I therefore met the Commissioner and argued for the use of Section 260 in these cases. saying that I agreed with his own counsel, Mr. Gleeson. He responded that the Solicitor General disagreed. I pointed out my power and duty to coordinate civil remedies. He remained unmoved. I enlisted the support of Gareth Evans, the new Attorney General, government having changed in the meantime. And the Commissioner was backed by Paul Keating, the new Treasurer. The matter was referred to Cabinet, and Bob Hawke mediated an outcome. The one case that had been prepared would be pursued. It was pursued and was successful, but by then it was too late to reopen the thousands of cases which had not used Section 260. One can only conclude that with the broad-based anti-avoidance provision coming into force, it was too embarrassing to breathe life back into Section 260. Now, I've listened with interest to the comments about the progress of Part 4A. I had a reasonably close association with it until about the last 4 or 5 years, and so I'm a little out of date. There have been a couple of periods in which which I think has been considered. The first period, it took quite a long while for the profession and some judges to realise that the Duke of Westminster, if not entirely dead, was mortally wounded, and that the words of the section had to be given attention to. That was broadly corrected in the line of cases that have been referred to by Tony Bogoni. But then we had the rise of the alternate postulate. Now, I do not know whether the High Court had the slowest idea what they were suggesting when that throwaway line was made, was given. But in the days sitting with Peter Walmsley in the GAR panel, I must say my head would spin, my eyes would spin with the task of finding these alternate postulates. It seemed to me to bring a quite unrealistic level of subjectiveness to the whole process. I can't comment upon whether or not the amendments have been effective, but as with all amendments, they will have their own ins and outs, no doubt. It is troubling that there have been no cases on these provisions, and I have no idea why that is so. Peter Walmsley may be able to help us about that. Thank you very much.
Yes, thank you. Thanks very much, Roger. So we turn to Peter Walmsley as the final commentator. Thanks, Peter.
Thank you. Well, to answer Roger's final question, perhaps I could say that I don't think that Part 4A is a black dog. It's more like a minefield with varying densities of mines. And I suspect that Kristen put her finger on it earlier when she said that once you begin to appreciate the fact that some lucky people can walk through the minefield and that others will be blown up, there's a tendency to not actually wish to locate specifically mines, but rather to do something to avoid the minefield. And insofar as avoiding minefields is the result of Part 4A, that is probably its intended effect. That would be a good thing, I suppose. But for this observation, which I feel obliged to make, generally speaking, the period in which Part 4A was devised and then first enacted and enforced was a period of close attention to the fundamental features of income tax law. Miranda, for example, referred to the introduction of controlled foreign corporation rules and foreign tax credit rules, and there were many, many other things that were done. But one unexpected effect of the introduction of Part 4A is it sort of created an incentive not to bother with any of that And I think we've probably had about 2 decades now of quite a lot of legislation in which, when the question is raised, well, you know, what about integrity? What about tax avoidance? The response is that's something that Part 4A can deal with. So I do sometimes feel that the meaning and operation of Part 4A may have remained constant, but its relative importance in the operation, it's not just income tax now, but other taxes, has grown. And as it grows, that the minefield in effect gets larger. So that perhaps more than anything is the most significant development over the last 20 years. The other aspect of it, which I have noted, and it's already been adverted to, is that the relative simplicity of the original conceptual design of the part has, I'm trying to think of a proper metaphor, is, let's say, it's undergone incrustations. You can still see the outline of the original ship, but there's a lot of coral on it now. Now, does that matter? I don't know. It's hard to tell, because we're in one of those interesting periods in which, as everybody has noted, there hasn't been much attention to it, but probably it ultimately will. From an administrative perspective, though, what I'd like to say is that, and now I'll go back to Tony's metaphor of dogs, that the committee that I have the honour to chair is something like the ethics committee of the Kennel Club. I think, well, we do see some examples of badly behaved dogs, and we see some examples of poodles too, I suppose. But the operation of it from the ATO's perspective is very laborious, very expensive, but I think works well enough within reasonably well understood limits and guidance. What perhaps might not be true. Oh, and I should add that I think that those professional advisors whose firms have the misfortune to interact with us have the a reasonable understanding too of the probable range of responses that they might receive at the GAR panel, which in turn interjects what I would call a sort of degree of customary, if not legal, certainty into its operation. But there must be very large numbers of taxpayers and tax advisors now who do not actually encounter either the GAR panel and are not going to go anywhere near a court, and who are increasingly, I feel, called on to question whether Part 4A applies to them in regards to provisions that have principal operation for unsophisticated taxpayers. And I'm not sure that the world is working quite as it ought in that area. It's hard to know because it's large and not visible to us. So it's sort of, yes, it works well within its originally contemplated domain. It's understood how it should work for the expanded domain, areas of international tax, untested though they are. And then there's this large unmapped region in where it's hard to say anything. Now, having said all that, if it weren't there, if Cridlin Mark II happened, the effect in our current system would be intolerable. And I do think that it has succeeded in its principal objective, which is to introduce a level of ethics into tax planning, that there cannot be many ethical tax advisors who do not advise their clients to be respectful of the provision. And as long as that continues to be the case, I think we can regard the task that was undertaken all those years ago as a significant success.
Thank you very much, Peter, and to all of our speakers and commentators. There are two questions. The first one is the briefer of the two, and this comes from Thomas Eckering-Gill. This is for the panel generally, but he adds perhaps Kristen. Any comments on the transfer pricing recharacterisation provisions contained in section 815.130 and their intersection with part 4A?
Well, I do think they have something in common, in a sense that they're both reconstruction provisions, and both of them require foundation facts to support a prediction. So there is a common element there. The parameters of the inquiry, though, are different, of course, because the recharacterisation provisions that are contained in the transfer pricing rules and 815B in particular are directed towards working out what the relevant parties would have done if they'd been dealing with each other at arm's length, and what the shape of the transaction would have looked like if that assumption had been made. Of course, the Part 4A prediction on the reconstruction limb under the new rules deals with what might reasonably be expected to have occurred if the scheme had not been entered into or carried out. So I think there are some common elements, but there are different parameters around them and a different object of the inquiry.
Yes, thank you. Would any other member of the panel or either commentator care to respond to that question? That is the relationship or intersection between 815-130 and Part 4A?
Well, I can offer one comment, if I may, and that is that the transfer pricing provisions proceed on the basis of a hypothesised relationship between the parties that isn't the actual relationship, and section 177D invites you to look at the actual relationship.
Yes, thank you. Any other member of the panel or other commentator? Now I'll come to the other question, and with respect to Mark Richmond, it is a long one. He starts off Kevin and finishes cheers, MR. So here we go. I have a question. Given that section 177CB appears to operate only for the purpose of identifying whether there is a tax benefit, brackets, see the opening words of 177CB1, and that Justices Gummow and Hayne in Hart said that 177D should be applied using a comparison with an, quote, alternate postulate, unquote. Does the panel agree that a taxpayer can rely under section 177D on a different alternate postulate? Brackets, that is, what it establishes by evidence is what would or might reasonably be expected to have occurred but for the scheme, to the one which gives rise to the tax benefit under 177CB. Cheers. MR. Yes. Now, Peter, you'll be on top of all of that. Would anyone like to have a go?
Kevin, I think the answer is probably no.
Well, Mark, you will have to put that question. I mean, it may be that when members of the panel or commentators can actually digest it, they may care to let you have a comment. I mean, it's obviously a well thought out question, and we know Mark Richmond. There's no doubt something behind it that we could come to grips with, but not right on the spot, not spontaneously. So if, as I said, a member of the panel or the commentators wish to respond to that direct to Mark Richmond, please do so. Now, they are the only two questions we have. I'm just going to throw this to the panel. Inevitably, the tax avoidance area is a technical area. That's in the nature of things. But we do read headlines in the newspaper about tax avoidance and so on, and we think that the general public doesn't really understand the difficulties. What, if anything, and maybe it's just a hopeless aspiration, but what, if anything, do you think can be done to make A, the press, and B, the general public aware of the issues with which Part 4A, for example, any of the anti-avoidance provisions seek to come to grips with? I've thought about this from time to time, and I think, as Murray Gleeson sort of said in opening, there is this question always about what's the proper scope for an anti-avoidance provision when people haven't broken any law, where what they've done, looked at in isolation, is totally lawful. There's no question of evasion or fraud involved. Is anything to be done? Can anything be done to educate the public and in particular the media?
Well, Kevin, since nobody else is piping up, I don't think so. I don't think anything can be done to educate the public. The issues are quite complicated, and even this group of people would have different views about what it all means. The work done by Murray Giles all those years ago was quite significant in educating the public about the issues, and it became public knowledge that there was a problem, that there was something rotten in the state of Denmark that needed to be fixing. But the detail of the state of rottenness, I think, is very, very hard beyond things that are relatively straightforward. Now, I'm not suggesting that the bottom of the harbour schemes were straightforward, far from it. They were quite complicated. But in a sense, when you get to the essence of it, they are, in one sense, at least for this audience, relatively straightforward. When you get the complexities of the nuances of things like even the Orica case, it becomes, I think, really impossible for an education campaign outside of the People's Republic of China.
Kevin, it's Miranda here. I might just add a comment about the international developments. It's been really quite problematic, I think, the way there's been this very strong emphasis on anti-abuse and anti-avoidance of multinationals. We might all have views about the fact that the jurisdictional rules should be properly extended to capture tax on global profits. But politicians, one would have to say, have leapt on the idea of corporate tax avoidance as being a dominant mode of international planning, and that has really meant that pretty much anything corporates do is perceived as anti-avoidance, which I suspect in the end does a disservice to Part 4A and operating the GAR in an appropriate way in its legal context and communicating that.
Kevin, you're mute.
Kevin, we can't hear you. We can't hear you.
Sorry, yes, if there's no further comment on that question, thank you, Miranda.
Kevin, I will just offer one comment on it. It's just a point that there is a significant feature in the two incrustations on Part 4A that they effectively inquire as to whether there is a main purpose of tax avoidance without troubling themselves with whether it's directed at Australia or foreign tax. And that probably does provide a proper criterion to distinguish impermissible versus permissible international tax planning, and therefore would tend to separate out activities of multinationals that perhaps to a layperson seem wrong, but are in tax within the policy framework of Part 4A are fine, from those that are not fine, because it was and is a serious weakness of the original provisions that an arrangement can have a substantial purpose of avoiding Australian tax, avoid a large amount of Australian tax, but not, and be otherwise only about tax avoidance, but get off the hook simply because it's some other country. That case involving the state income tax of Illinois exemplified that issue. Noza.
Yes, thank you. Well, at this point, ladies and gentlemen, I'll hand over to the President of the Academy, Alan Robertson. Thank you, Alan.
Thank you, Kevin. You will all agree, I think, that this evening's addresses and commentaries have been deeply thoughtful and have been given by exceptionally qualified speakers and on an essential topic. We've had the benefit of hearing the history of Part 4A, both political and legal, the development of its terms, where things now stand in its administration in the courts, and the international context. It's been an evening of great interest, not only to tax lawyers, but also to policymakers and those concerned with public policy. Although we won't be able to hear you except virtually, please join me in thanking warmly each of the speakers, Mr. Murray Gleeson AC, the Honourable Tony Pagoni QC, Ms. Kristen Dierds of Senior Counsel, Professor Miranda Stewart, the commentators, the Honourable Roger Giles, AOQC, Mr. Peter Walmsley, and of course the Chair, the Honourable Kevin Lindgren, AMQC, who has brought the proceedings in on time, if I can use that expression. We live in hope that the next of these events will be able to be held in person, that Tony Pagoni by then will be repatriated, if that's what he wishes. And when these events, of course, are held in person, we have the additional intellectual and social benefit of personal one-to-one discussion. So thank you all for participating. Thank you all for attending. And I now